Bubble, bubble, toil and trouble. What's the next line, Andrew? Fire, cauldron, something hubble. What's going to happen in the property market next year? Tell me, Adrian! Now, come on, get your mic.
You were getting weirded by the webinar.
Welcome back to another month, another webinar here at Opus Plus for Property Life. And for anybody new, that was just a little reference to our most recent social media ads that we've got a little bit kooky again. So good to see you guys. I love somebody was like, Harry Potter. Well, it was. And we've got our predictions for you today that we can't wait to take you through. Heidi Shepherd says, Ed, you completely cooked. Well, thank you, Heidi. I take it as a great compliment. Now, Andrew, what are we talking about today while I get my keyboard?
Well, I think this year firstly we're gonna review last year's predictions. So every year we do this, we look at what we said last year was going to happen, and whether or not we got it right, whether or not we got it wrong. Whether or not Ed got it wrong, and then we're going to take a look at what our predictions are for the coming 12 months.
Fantastic. And so we are going to rip straight into it and start looking at, well, what were some of those predictions last year? And the thing that's really important when we think about property investment is we're always constantly thinking about the long term. So we're thinking about 2044 and beyond. But what we sometimes really want to know is, well, what's going to happen over the next year? Now, we put out our calendar of property investment predictions last year in 2024. Not looking too bad with that cat,
Heidi
Andrew.
and Nathan are watching. Don't worry, I've got one for you for Christmas.
And let's look at some of those predictions. One of them was that Chris Bishop, the new housing minister, would axe Kiwi Build. Now, this is one of the ones that I gave a very low likelihood to, Andrew.
Yes, you did. I, on the other hand, thought absolutely this was going to happen. There would be some change here, and Kiwi Build would either be axed or kind of, at least changed in some sort of significant way. I got it right.
Yeah, we saw in May, the 20th of May, not too far off our June prediction, that the Prime Minister and Chris Bishop did decide that Kiwi Build would be scrapped. So Andrew was right. I unfortunately was wrong. We also put out some interest rate predictions. And I think we said at the time, interest rates were 7.2%. And I thought that they'd come down to 6.6% by this time in 2024. They're actually sitting just below 6%. So Christmas came early from Adrian. We've seen interest rates go down, and that's really good. But one of the predictions that we actually got wrong. Well,
hang on a minute. I want to just hit you up about that. On our podcast, so every year we do, I think it's the 24th of December, we do All I Want for Christmas, and we have our wish list for Santa. And last year, I said I saw interest rates, or I thought interest rates might end up around 5.5.
Well, let's listen to what Andrew actually said. We'll play it. Andrew, what do you want for Christmas?
So I think the biggest thing I want to see next year, or have from Santa, is inflation within that 1 to 3% band of what the Reserve Bank targets, because that's going to lead to my next...
Okay, you got that one right. We got that one right from Santa. But you also had an interest rate prediction for anybody who's just joined us. This is what Andrew wanted for Christmas last year.
Request, which is more sensible interest rates at a more normal long-term level. Now, I don't expect that I'm going to get a 4.5% next year, but I do want to see kind of maybe a 5 or a 5.5.
Yeah, well, you don't get that, did you?
5.5. You can get 2-year fixed 5.5.
At one bank, you could get 2-year fixed for 5.5. So Andrew and I have been bickering about this. We'll see.
I'll call that a win for me, a loss for Ed. Let's just talk that up.
We'll believe that. On top of that, there was a big argument last year about rents. About rents were going to, whether rents were going to continue going up. I said that rents wouldn't go up as fast in 2024. Andrew said that, but rents are still going up now. And I said, but property investors are coming back into the market. Wages aren't going up as fast. And who's got the economics degree? And it turns out that Andrew was wrong. And I was right, as per usual. But there was something else, Andrew, that happened. We made a prediction about builders going bankrupt.
Yeah, I think we said builders and developers are going to go bankrupt, not necessarily in November, but throughout the entire year. Funnily enough, just as Ed and I were getting ready for the webinar tonight, I got another developer had gone broke in Auckland, put into liquidation today. I saw the notice today. There's been no shortage of these, including one of the more public ones, Deval Group, going from a $750 million business, sure, to negative 250.
Yeah, and on top of that, company liquidations have hit a 10-year high, a lot of that concentrated in the building sector. So, Andrew, how many did we get right? How many did we get wrong?
So, all up, last year, we got a massive 9 correct and 3 incorrect. But I'll still call a few more extras for me. Now, of the serious ones, that was, what was it?
We got about
7 out of 10.
7 out of 10, right, which is not a terrible hit rate. But now we're back with some new predictions, a new calendar. I'm sure you'll all be looking for that. It'll be available in Whitcoulls.
Who came up with this?
Our graphic designer, Kane, who currently lives in Mexico, and so maybe he was on something when he put these together. So they will not be available in Whitcoulls, by the way, but we like to dream. Now, Andrew, there's a lot of people here tonight, right? So there's going to be some people being like, who are these guys? Why are they turning up with like a cape and a Harry Potter cape and a crystal ball and these weird pictures of themselves on a calendar?
Yeah, so if you haven't heard about who we are or don't know who we are, and you're asking yourself, why should I listen to these crazy guys? Then I'm just going to take you through that. So we do have New Zealand's #1 business podcast, the Property Academy podcast. It's been going for over 5 years now, and it's a daily show, 15 minutes of anything property related. And we've now had 9.3 million downloads of that podcast. On top of that, we have done over 50 webinars now. We started these and started doing weekly webinars in COVID lockdown because we had nothing else to do. Now we do them monthly, and there's a whole range of topics on our website if you haven't seen the previous ones. We've got 17 financial advisors across the Opus Group, and our book is currently in bookstores. And Ed, he's our economist here at Opus Partners. He's a property investor and writes frequently for the New Zealand Herald. Every week now, is it?
Yeah, every week on One Roof.
I'm a financial advisor and managing director of Opus Partners. I'm a property investor and I write for stuff.co.nz. So here's what you're going to get tonight. So the webinar is free. The Q&A section at the end, which is one of the best parts of the webinar, that's free. So stick around till the end for that. And the recording, you'll get that emailed out to you tomorrow. So if you miss anything, if you're coming in now, I see lots more people piling in. If you miss anything, you'll get the email recording tomorrow.
And really important, you guys, what's going to happen throughout this webinar, I absolutely guarantee you, is people are going to come in and say, I came in late. Is there a recording available? It's going to happen at least 5 times. So if you wouldn't mind just letting those people know who ask, is there a recording available? There absolutely is. Now, Andrew, I know that this is your passion project.
This is. Okay, so we've got 2,200 people signed up for tonight's event. As a community, we want you to all be able to talk amongst yourself, particularly because Ed and I get very caught up in the presentation side of things. So to make sure you get the most out of tonight, in the chat, make sure that you're selected to everyone and put your chat in the chat part. Don't put your questions in the chat part because we will miss them because we'll be talking. So if you've got a question, there's a Q&A tab. Make sure you put it in there. We'll try and answer as many as we can at the end. There's where you can find turning your chat to everyone rather than just hosts and panelists.
Fantastic. So let's go through this calendar. And for January, I am certain that Uncle Lester is going to be back. And some of you will be like, who's Uncle Lester? So Uncle Lester is that uncle that always shows up at the family Christmas barbecue who knows absolutely everything about property investment, or at least he thinks he does. And he might say some things like property investors, they don't add anything to the community. But actually, I think here's what Uncle Lester is going to be talking about at your Christmas barbecue. I think he's going to be talking about that there's an oversupply of housing in New Zealand. And one of the reasons he might think that is if you look at net migration right now, we see that net migration is falling off what the highest it has ever been at about 130,000. It's falling back to its more long-term average around 50,000. Now, old Uncle Lester will look at this graph and say, whole heap of people leaving New Zealand, even though there's more new people coming over here. And on top of that, Uncle Lester's going to be looking at New Zealand's current housing stock. So this is the number of properties that are currently available on the market, on TradeMe, on OneRoof, on realestate.co.nz. And so Uncle Lester's going to be putting 2 and 2 together, and he's probably going to be saying things like net migration is going to keep falling, housing stock, that is going to keep increasing. And one of the kind of mental traps that I know Uncle Lester sometimes falls into is something that we call extrapolation bias, which is that we know that things like property prices, property stock, even net migration is very cyclical. Sometimes it's up, sometimes it's down. And yes, at the moment, we're seeing that housing stock, the number of properties available for sale, is very, very high. Good for buyers, bad for sellers. On top of that, we're seeing that net migration is falling off a really large high. But old Uncle Lester, he'll fall into extrapolation bias, which says that those housing listings, they're going to keep on going up and up forever, and net migration is going to keep falling to the point where there's nobody left living in New Zealand. And so that's one of the things that I just want you to watch out for when you are at your Christmas barbecue, talking to some of your family. This is what old Uncle Lester will be talking about. Now, Andrew, what are we seeing in February?
So February, we're going to see interest rates keep on falling. We're going to see more OCR cuts. We're going to see interest rates going lower, but they are going to hit a floor. So again, I don't expect we're going to see a 4.5% interest rate necessarily next year. I think you're going to see more lower interest rates. But if you think about how far interest rates have come since start of this year, it is pretty remarkable. So ANZ's advertised interest rate at the start of the year, 7.39%. And I know we were kind of thinking, okay, rates are going to be sticky. They're going to be staying around high levels for a wee while now. ANZ have had 9 interest rate drops for its 1 year interest rate, 9 cuts since January. And we're in November. And we're now down to 5.99, a massive 1.4% off your mortgage interest rates. And that is having a big effect on borrowers at the moment. So I know there are a lot of investors that are still on fixed rates at the moment, but now the light's at the end of the tunnel. And when you look at the OCR forecast that comes out from the Reserve Bank, they're saying, okay, the OCR could get to kind of 3% by 2027. Now, that doesn't mean your interest rate is going to be 3%. It doesn't mean that interest rates are going to drop as much as the OCR is dropping, but it does show that there is momentum in the right direction for more affordable lending.
And actually, before we share our interest rate predictions, I want to come to you guys, because you guys always have some of the best comments. I want to put a poll across your screen. Now, don't put this in the chat because we're about to put it across your screen, but what do you think the 1 year interest rate will be by November 2025, in 1 year's time? Producer Dave is going to put poll number 1 across your screen. Is it still going to be above 6%, i.e. is it going to go up? Is it going to be closer to 5.5%, 5%, or is it going to be 4.5% or less? You guys put it in now, and already over 300 of you have answered that poll.
Some really interesting answers here.
What are you seeing in the chat, Andrew? Anybody saying anything?
Someone asked who was the developer that went into liquidation today. Hang on, let me just make sure I give you the right.
You texted it to me before.
Yeah, I did.
But while you're finding that,
Citadel Capital.
Well,
based out of Auckland.
While you're doing that, we're going to end the poll in 3, 2, 1. And producer Dave, you share the results for us. Cool. So a massive 57% of you, most of you, think it is going to be close to 5%. About 17% are saying, hey, look, I still think it's going to be at 5.5%. And about a quarter of people who answered that poll, over 500 of you, are saying, I actually think the 1 year rate is going to be 4.5% or less. And I'm going to stop sharing that now. Now, what's interesting is that the good news is nobody really knows what's going to be, right? So we all get to have a bit of a guess.
Yeah, and I know that if people are doing their modelling at the moment, I think you should be really, really conservative around the interest rate drops. And then if you get a happy surprise, we do see a 4% interest rate in the next couple of years, then that's even better.
But I think a lot of people, or some people, will be looking at those OCR drops, rubbing their hands and saying, interest rates are going to be 4% again. But there's a really good reason to think that that might not be the case. Walk us through the math, Andrew.
Yeah, so if you talk about the OCR at the moment, at the peak, 5.5%, the current OCR interest rate is 4.75. The difference is 0.75%. So 0.75%. If you look at the actual changes in real interest rates, so the ANZ rate, 7.39, down to the cheapest kind of rate that you're getting for a year fixed at the moment is 5.59, that's a whopping 1.8%. So you're thinking, well, that's over 1% lower than what the change is in the OCR. Now, the reason for that is because the market already expects the OCR to drop some more. So for a lot of people who I've been talking to recently, they're sitting on the sideline saying, I want to wait for the OCR to come down on the 27th of November. I think everyone believes that that is true. How far it comes down, we don't know yet. But let's say it comes down another 0.5%. Does that mean interest rates are going to drop another 0.5%? Probably not. It'd be nice if it happens, and look, there's no guarantee that it won't happen, but the chances are it won't because the market has already priced interest rates accordingly because the expectation is that it's there for another drop.
Yeah, and if we think about how far can interest rates go, the Reserve Bank is saying, look, the OCR peaked at 5.5%. We expect that we'll take it down to roughly 3%. That's what they've got in their modelling. That is a 2.5% fall. Now, if we copy that 2.5% fall over and we say the peak interest rate for the 1 year rate was about 7.4%, take 2.5% off it, you get to roughly 4.9%. So I think a 4.9% rate in kind of 2026 is much more realistic than a 4% rate. Now, Andrew, if we think about our actual interest rate predictions, what are we thinking?
So we're saying right now, 5.79 is kind of about the average interest rate you might get for 1 year fixed. By this time next year, we're saying 5.3%. Ed and I always tend to disagree a little bit on this. Ed's a bit more...
Why, what are you saying?
He's a bit more conservative. I reckon we'll see 5. I reckon you'll see 5 or lower.
Yeah, okay, well, we'll see.
Well, I mean, I got it right last year, so I mean...
Andrew Nicol, property economist, researcher extraordinaire.
No, I do this, and sometimes I'm right. 5.3% as what we're saying as a company next year. When I say we as a company, Ed's saying, because he's got the economics degree. November 2026, we're saying 4.9.
Let's come to March. I'm thinking that banks are going to really start lending like it's 2019. That's right. We're going to party like it's 2019 again. And one of the important things it's so crucial that you understand this if this is the first time you have come to one of these webinars, is that if you go online to a mortgage calculator, and you don't have to use ours, and you plug in your current interest rate, 5.99%, you might see the weekly repayment and think, yeah, I could afford that. But the bank doesn't do it that way. What the bank will do is they're going to test your mortgage not on the 6% interest rate you're going to pay, or maybe 5.5% if you're fixing with that one bank offering the 2-year rate, but they're going to look at 8.15% or 8% at the moment. And so they're testing you at a much higher rate. Now, this is really important because the lower that servicing test rate, the lower the rate that the bank is using to test your mortgage, the more you can borrow, all other things being equal. Now, the reason I bring that up is if we look at what the test rates banks are using at the moment. So at the start of the year, ANZ was peaking at around 8.95%. They've cut their servicing test rate by 0.9% this year. That matters a lot, and I'm going to give you an example of what that actually means for you in a second. If we look at ASB, they've chopped 0.85% off. They've gone from just under 9% to just above 8%. BNZ, they made it simple for us. They went directly from 9 to 8%, and Westpac, they've gone from 9.1 to 8.15. So we've seen some pretty substantial cuts to the servicing test rates. My pick is that we're going to keep seeing these coming down. As I've been kind of looking at the banks lowering those servicing test rates, they've lined up more with the OCR cuts. Now, that doesn't mean that we're going to see another % coming off these, but I'd expect to see maybe 0.5% come off over the next 6 months. Now, to figure out how much you can actually borrow based on this, there is a really complicated formula which I came up with myself.
Isn't this the theory of relativity?
I wish this is the theory of relativity. This is maybe the theory of relative lending based on servicing test rates. And this is the real formula that I use to calculate different situations. But I'm going to make it really simple for you guys. And I want to give you a scenario, which is, let's say we've got a couple, the Keen Cantabrians, they earn 90 grand each. They own a house with 700 grand, which is pretty average for Christchurch. They've got a 400k mortgage, and they've got 1 kid and 1 car. So just from an income perspective, for all you nerds, what we call a UMI perspective, at a 9% test rate, my spreadsheets say they could borrow about $1 million for an investment property. Now, if the test rate comes down to 8%, at a maximum, I reckon they'd be able to get something like 20% more.
It's a big increase.
Yeah. And what's really interesting is not every single person is going to see a 20% increase in terms of the amount that they are able to borrow with these servicing test rates coming down. It's quite personal based on your own situation, your own scenario. But it gives you a feel for how these servicing test rates can mean that you can borrow potentially a lot more. It just depends on how much income you have, how much debt you currently have, and a couple of other things. So I'd expect it to look good, at least from a servicing test rate perspective. But Andrew, there's another new rule coming in that we're probably going to have to worry about when it comes to April.
Yeah, so at the moment, because the banks are testing your servicing ability on such a high interest rate, the new DTI rules that have been brought in, the restrictions that the Reserve Bank set on your ability to borrow money, they have no effect. So right now, if you're going to a bank and they're testing you at an 8% interest rate, you can roughly borrow about 5 times your income. Now, with the DTI rules that are already in place, they're already there, effectively people could only borrow about 5 times their income. So what that means is it's lower than the amount that the DTIs allow, which is 6 times if you're an owner-occupied, 7 times your income if you're an investor. Now, as those servicing test rates come down and we get to somewhere between a 7 and a 7.5% servicing test rate, you're going to be able to borrow more money. But the DTI rules will overlay your ability and they'll slow down the amount that you can borrow.
And one interesting thing is BNZ recently released a new calculator for mortgage advisors to use. I look forward to finding out what you're giggling about.
Ben.
What was I going with this? BNZ has recently released a new calculator for mortgage advisors to use, like a spreadsheet to check how much somebody can borrow. They've now put debt to income ratios in there. And so we know that banks have started to test this. One thing that's important to point out, though, is there is a DTI limit. So banks can lend up to 20% of their borrowing at above or outside of the DTI limits. Now, at the moment, most people are well below it. So investors, they are only borrowing, only 3 or 4% of investors are borrowing outside of the DTI rules. Other home buyers are at like 3.9%. If we're talking about first home buyers, they're even lower, 1.5%. And so there is some room for lending to grow, even though the DTI rules are there. It's basically like if the speed limit is 100k an hour, we're kind of driving at 25k an hour at the moment. I don't think the banks are going to speed up fully to the 100k an hour, but we could get up to 50k or 60k an hour pretty easily. So there is some room for expansion in terms of lending, even with those DTI rules. In terms of May, though, I want to get away from banks and lending and interest rates for a second. One of our predictions is that 3 major developers are going to go bankrupt. And one thing that you might say is, but Ed and Andrew, isn't the property market starting to go okay? Like, wouldn't you expect that developers will be able to recover because property prices are likely to go up over the next year? I'm going to show you some house price predictions shortly. And now that interest rates are coming down, wouldn't that be good for property developers? Why do you think so many are going to go bankrupt? And one thing that's really interesting, I want to show you some data from the New Zealand Institute of Economic Research. So this shows us a survey of people in the building and construction industry. And they go out, the New Zealand Institute, and they ask people, well, what is the biggest constraint to your business? And what this is showing you is the percentage of developers and people in the building industry who say demand is the main thing. Lack of customers is the main thing holding my business back. And what you can see is at the moment, just over 80% of people in the building industry are saying it is demand. It is customers. That is what's stopping me from growing my business. That's what's stopping me from my business being successful. That is a similar level to back in the global financial crisis around 2010. So yes, I probably would expect the property market to recover. I probably do think that interest rates are going to come down a bit more. I probably do think that house prices are going to rise. But I still think that developers are really going to hurt. I want to show you some data that is going to really open your eyes. I literally only showed the data that I'm about to show you right now. I only showed it to Andrew probably When was it?
Few hours ago.
Few hours ago over lunch. So I want to talk to you about Stonewood Homes. Stonewood Homes used to be one of the top 3 largest property builders in the country. And according to BCI, they were building over 800 properties a year, or they had consented over 800 properties a year back around that 2013, 2014. Today, they are at under 80 consents over the last 12 months. Now, this is not me saying that Stonewood Homes is going to go broke.
No. We're going to be very careful. You're going to end up in the boot of the Chow Brothers car with that kind of talk.
Yeah, so I'm definitely not saying that this is the developer who's going to go broke. But the reason I wanted to show you those specific numbers is Stonewood is a pretty big brand name, right? We all know it. We all know that they're builders. But what's interesting is they are now 10 times smaller today than they were just 10 years ago. So especially in the development business, you can have brands that become quite well known and then even still shrink quite a bit. I want to show you another stat. So this is Gideon Homes. Look at their consents per year. So Gideon has been around for like 27 years. And again, I'm not saying that Gideon's going to go bust. That's not the point of my little chit chat right now. But what we see is they had their best years in 2021 and 2022, according to BCI's data. They had consented more properties than they ever had within this data set. Yet in 2024, they have just had their worst year in terms of consents in over 27 years. And so again, yeah, I do think the property market's going to recover. I think things are going to be better for buyers. But in terms of developers, in terms of sellers, I still think it's going to be really tough. One last little comment. If I think about that quarterly survey of business opinion that the New Zealand Institute of Economic Research do, they often ask builders and people in the construction sector, how is your profitability going at the moment? For builders and developers, it's going down. A lot of builders and developers are saying, we actually think we're going to have to lower our prices over the next 3 months, over the next year, but we think our costs are going to go up. And so because of that, I think we're going to see some margin squeeze, and we are still going to see some real pressure from some of those developers. Now, if you're out there investing in new build properties as a buyer, that probably means you're going to get a pretty sharp deal, even as the rest of the market recovers. So there's some silver lining if we're buyers as opposed to developers, and some developers will still go well. A little later on in the presentation, I'm going to show you one developer or house builder who is bucking this trend and is growing like billios over the last couple of years. Andrew hasn't even seen that yet, doesn't know I'm going to show that data, but something important to recognise. Right, we're almost halfway through the year, Andrew. In June, we're thinking the government's going to shake up tenancy laws.
Yeah, and I think that actually this is going to be a shake-up in a positive direction for landlords. Now, as landlords, we have seen it pretty tough with increased regulation around renting our properties out over the last 6 years, 8 years. It has been tough out there. And look, some of the things that have been implemented, for example, letting fees, right? Previously, you charge a letting fee to an incoming tenant. Now the landlord pays. I completely agree with that. I think that's completely fair.
When you think about it, it's a bit ridiculous that we were getting the customer to pay the property manager for turning up.
It's like
it was a service for landlords.
Yeah, I go buy something from somewhere and then they charge me on top of that for having the pleasure of buying it.
Yeah, so if you went to the supermarket and you walked through and you've got the person scanning your groceries and they charge you a fee for that.
Yeah, ridiculous. Anyway, so as a result, there are some changes that have been made that I'm all for. But there have been some really tough ones as well. So the no-cause tenancy clause, for example, like being able to give your tenants notice to sell your property or something like that, they got a bit tough. And as a result, there are a lot of landlords that said, you know what, this is too hard for me now. And so they have left the market or they haven't been buying as actively. The interest deductibility, that was a terrible one. So I think you're going to see a more return to normal or fair. Again, some of those things that maybe are in there now, they're not going to go away. Things like healthy homes, which again should absolutely be a right for a tenant. If they're renting a house, it should be healthy for them to live in there. It should be warm and dry and safe. But there are going to be things like, for example,
the no stated termination.
Yeah, so if you as a landlord have a reason that you have to get rid of someone, yeah, I kind of think that, yeah, you should have the right to be able to do that within reason. And so we're going to see some things return to a more normal, balanced approach. But then also I think, there are some really sensible provisions coming in, like, for example, pet bonds. So at the moment, if I want to if I want to sign up a tenant who has a pet, and I'm a bit worried about the pet causing damage, I can't charge a bond to cover that pet damage specifically. So the government are looking at bringing that in. So now I can say, okay, well, look, you've got a cat and I'm a little bit nervous about cats. I'm not, by the way, I love cats. I'm going to charge a few $100s extra on top of the bond to cover any damage from the cat. I think that's completely fair, and as a result, creates an environment where, look, let's face it, if tenants wanted a cat, they just get the cat anyway. Now they can be honest about it and just pay the appropriate bond. Everyone's happy.
Okay, so we're halfway through the year and we've seen changes to interest rates. We've talked about Uncle Lester. We've seen that banks are probably going to lend a little bit more, but then DTIs are going to come back. We've talked about a pretty tough environment for developers and a shake-up in tenancy laws. One thing that I think is going to happen, and I know for certainty is going to happen in July, is Opus Plus is going to get a major upgrade. And one of the things that some of you might be thinking is, what the hell is Opus Plus? So this is a piece of software that we released, when was it, Andrew? Was that a recent webinar? When was it? It was maybe 2 or 3 months ago.
It was
2 months ago. 2 months ago it was. And this is an app that you can use to put in your real properties and then look at what the cash flow is going to be and look at how your property may grow in value over time.
It's getting better and better.
And actually, one little update I want to show you that some people will be really interested in, because I got a lot of questions, is if you're looking at the cash flow graph of what's going to happen to your property, you can now click this little table button and it breaks down all of the numbers so you can check what is actually going on in here. Now, I don't want to get too much into that, but there are 2 major changes that we're going to release over the next 6 months that I just briefly want to tell you about. The first one is Opus AI. So what is going to happen is, let's say you are working with one of our financial advisors and you are in our software. By the way, I just got these designs like this week, and so that's why I want to show them. So let's say you're working to build a plan for your future. You can now add properties to your plan with AI, and after answering a question to prompt the AI about what do you actually care about. Do you want to buy as many properties as possible, close your wealth gap, or just build as much wealth as possible? The AI will model out, okay, what properties should you buy to maximize your wealth, but also what properties can you actually afford in the future? So one of our most popular webinars earlier on this year, I gave away a spreadsheet that actually planned out how many properties can you buy over time. We're now giving that spreadsheet to AI, and very soon you will be able to use artificial intelligence to plan out your property portfolio. And this is an example of what it would look like in terms of how many properties you can actually buy and what you can afford. There's one other major change that is coming to you, and I literally got these designs about 6 hours ago. So I want to show you them. One of the big questions that people have said to me, or frustrations they've had, is, Ed, it's really difficult to manage my property portfolio. You know, if I get my property management statements, they come through an email and I've got to dig through my emails to find them, or my accounting statements, or any of my mortgage information. One thing that's coming mid next year in July is when you go in and look at your properties, you're going to be able to click things like property management or mortgages up here. And what's that going to do? That is going to show you who your property manager is. It's going to show you the rent per week. I'm so glad. I just looked at that, Andrew, and I saw Kim Jones there, who's one of our property managers. I thought, oh gosh, I hope we didn't put her real phone number on there. Everybody's going to start
anyway.
Oh, that's true.
No one's going to be texting, "Hi Kim, saw you in the webinar."
Yeah. So just for clarity, her number isn't 01212234567.
Well, just I got to interject for a minute. Why don't you tell the story about when you helped build our website?
Which one are you talking about?
So I had an email one night from a guy, and he said, "Look, my daughter's been trying to get hold of you for months, and no one's ringing her back. It keeps connecting to Domino's Pizza." Anyway, Ed, as a placeholder, put Domino's Pizza's phone number on our website. No. It was Pizza Hut.
It was Pizza Hut. What happened was, that's a good story. Andrew has ruined my flow, and he got all grumpy when I ruined his flow at another presentation. But this is quite funny. This is quite funny. So we were building a first home website when I just started at Opus. numbers, and I'd put as the phone number, just as a placeholder, 0800 83 83 83, because it's Pizza Hut.
Sing it.
0800 83 83 83. And anyway, so yeah, the guy was like, it keeps going through to Pizza Hut. That's pretty funny. But anyway, back to Opus Plus. You're going to be able to see what your property's renting for per week, you know, when you last increased your rent, when you could raise it again, how long that tenancy's been going for, whether it's a fixed term, and your tenancy agreements, your rental statements, and your inspection reports. If you click on mortgages, you're going to be able to see all your mortgage information. Who's your mortgage advisor? How much debt have you got? Which bank are you using for that specific property, and what are the repayments for that? So there's a lot more to it. I don't want to make this big presentation about Opus Plus, but I just want to say there is some really exciting stuff coming. I know, Andrew, you got all upset that I put the likelihood of those major updates happening at 110%.
Yeah, well, 100, with the bills that we're paying towards this, it should be 110% at least.
But I just wanted to mention there's some really exciting stuff coming for you guys. Cool. Let's come to August, Andrew.
I think you're going to start to see a bit of momentum in the housing market next year, and certainly in those undervalued regions at the moment. So again, if you're long-time listeners, you'll know what I'm talking about. If you're new tonight, one of the models we use is to measure how a city or a town is performing compared to its long-term average. So is it cheap or is it expensive at the moment? Cheap places are places like Christchurch or Auckland particularly. I think Auckland, you're going to see some real momentum around August, heading into summer next year. I really think you're going to see some serious momentum, and that's when it becomes a bit of a seller's market again, because the price is going to start to move.
And one thing that's important to recognise is if we look at what's been happening in the property market, we saw house prices falling pretty consistently between December 2021 through to May 2023. Then from that kind of bottom of the market in May 2023, we saw house prices recovering by, for that last half of last year, the start of 2024. Then we saw house prices taking a bit of a dip again. But the momentum, the pace of those dips, the size of those falls has been falling over the last 5 months. We saw no change in house prices in August, and we saw house prices starting to increase in September. Over the next couple of days, I'd expect to get the latest Real Estate Institute of New Zealand house price data, and it'll be interesting to see what happens in October. But there's a really good reason for thinking that we'll start to see some increases throughout October and also November, and it all comes down to, well, what season of the year are we in? So the housing market is very, very seasonal. We see that there is typically slower house price growth at the end of autumn and the start of winter. And as we head into spring and late summer, we see those house prices starting to rise. That is the trend that we tend to see. So the fact that we saw house price growth in September somewhat doesn't surprise me, because we are starting to head into the thick of spring. That's why I'd also expect to see house price growth within October, maybe November, and also probably in February next year. Now, we're saying that we think that we'll see some good house price growth by August next year. The reason is we'll get through this summer, and we'll also be starting to head into next year's spring, all of which tends to be a good thing for house prices. On top of that, we've started to see a change in media articles. Here's one that both Andrew and I were quoted in about has the tide finally turned for housing market growth? If you haven't checked that out yet, it's available on the Post, written by Miriam Bell. But one thing I want to do is get to understand your guys' house price predictions before we show you the bank's ones. So producer Dave is going to put another poll across your screen. How do you think house prices will change next year? Are they going to go up by over 8%? Are they going to go up by roughly 5%, 2%, or are they going to go down? And again, this is one of my favourite things, getting a little bit of
You've got 800 people in the room at the moment. It's really interesting to see what the wisdom of crowd says around interest rate predictions.
Yeah, I absolutely agree.
Sorry, price increase.
And we're actually going to show you in a second what the banks are predicting as well. As soon as we get over that kind of 500, 550 mark, once it starts to slow down, we'll probably end that in 5, 4, 3, 2, 1. Producer Dave, end that poll and let's share those results. So the majority of you, 51%, are saying, look, we think roughly 5% is how much house prices are going to go up. About a third of you are saying, look, I think 2% is reasonable. Some of you, small percentage, think hey, I think we're actually going to see some falls. And about 76 people in the room, 14% of you guys, are saying we think that house prices are going to go up by 8% plus. Now, the good news is you can actually all be right, because I've always said there's no such thing as the New Zealand housing market. There's just 67 different housing markets all put together. So the Queenstown market is going up like Billy O's, or recently has throughout 2024. You've seen a lot of house price growth, whereas other parts of New Zealand have seen house prices fall. And so we can all be right within our specific area. But let's take a little look-see, Andrew, at what the banks reckon are going to happen to house prices. I'll zoom in it for you. ASB is very bullish, right?
ASB really bullish, 10.9%. They're talking nationally, is that right?
That is for the whole country.
And when you think about the fact that some areas won't go up at all, some areas might go backwards, if I were going to put some money on it, I don't think Wellington's going to see any growth next year, or very little growth, right? Does that mean that then Auckland sees 12% to kind of balance it out? Maybe. Who knows? BNZ 6.5%. I think that's pretty realistic for a lot of the undervalued regions. Westpac, similar sort of amount. RBNZ 4.8%. ANZ really conservative, 4.5%.
And I've kind of stuck with that. By the way, this is available on our website every kind of month or two. I collect all of the bank's latest house price predictions. The last one for ASB was legitimately in August. Just checked that before we came on the webinar. If you just Google house price predictions, it's going to be the first thing that comes up in Google. So you can just have a little check about where house prices are going to go. One thing that I do want to mention is sometimes us property investors can kind of get really sucked in to what is happening over the next year and miss out on the big picture.
Yeah.
One thing I want to share is the Reserve Bank's house price forecast for the next couple of years. Now, it won't work out as smoothly as the Reserve Bank projects, but they're saying that compared to September this year, they reckon over the next 3 years, house prices are going to go up by 15%. That's their forecast at the moment. Westpac is another one that puts out cumulative house price forecasts. They reckon that between, roughly 2024, right throughout, if we project right out to the end of 2030, over the next 6 years, house prices could go up by roughly 27%, 28% by their numbers. And so that is the long-term trend that most of us are investing in as well. Right, Andrew, those are the house price predictions. Let us come to prediction number 9, and we've got, 4 more to go. We're going to talk about September, and here is one that is very close to a lot of people's hearts. It is council rates keep climbing. I've given this one a likelihood
100%
of 100%. And I got to tell you the reason why.
Now, hang on. Can we set some parameters around this for next year? Like when you say keep climbing, are we talking inflation? Are we talking higher than inflation?
Oh, definitely higher than inflation.
How much are we talking?
I reckon at least double inflation.
Double inflation?
Yeah, double inflation, easily.
Okay.
Yeah. That we'll put that.
Remember that. We're gonna chalk this up. I'll see you next year.
Now, somebody said but just remember that we are seeing different things at different councils, because there are 67 different local councils around the country, right? So you've got Wellington City, which has just had a commissioner installed, not a commissioner, an observer, a Crown observer installed. We've got Auckland, we've got Huranui District, we've got my hometown of South Taranaki. You've got 67 regions. So not every single area is going to see a significant amount of rates increases, but some will. If I show you the Wellington City Council forecast, it's astonishing. They were forecasting, when I got this data, an 18% increase for the current financial year. They're saying over 10% for next year and 13% the following financial year. Add it all up, over the next 9 years, they're expecting to see, or projecting, that rates would go up by 77%.
In Wellington.
In Wellington City alone.
They're really hurting at the moment.
I think, both in terms of the city council, but also in terms of the wider economy in Wellington City, with some of those redundancies that are going on. So some places really are going to struggle, and that's going to flow through into property investors' cash flows, because rates are one of our largest operating expenses. So apart from the mortgage, rates tend to be the largest thing that you are paying, and a lot of councils are hurting at the moment, so just watch out for that. Talk to us about what's going to happen in October.
Okay, October, we're going to see government passing new minor dwelling rules. So the government's talking about making it much easier for you to put a minor dwelling on the back of your house. So, for example, you got your house at the moment, you've got a big backyard, you can put a minor dwelling. What was the size of a minor dwelling? The maximum?
The ones that they are planning on doing is 60 square metres. So anything less than 60 square metres, the latest discussion document is that you won't have to go and get consent as long as you meet certain requirements, specifically if you use a licensed building practitioner to oversee the work. That is a little bit different from what they propose in the coalition document. They said as long as you get an engineer in, but it's changing to be an LBP, licensed building practitioner.
So say you get someone to come and do that, all of a sudden they're going to put another, it's probably a 2-bedroom unit. You probably quite comfortably put a 2-bedroom unit if it's just a completely flat site. That's actually going to make it a lot cheaper for people to have minor dwellings put on their home. And when I say cheaper, at the moment it costs kind of 200 to 300K to put a minor dwelling, give or take. That will come down by kind of somewhere between 10 to 30K is the best estimate. That's a lot of money saved. And so for people who are thinking, yep, you know what, I want to get some more money out of my rental property, or I want to just have another space for mum or dad to come live at, awesome. You're going to be able to do that with ease.
That's really lovely that you want your parents to come and live with you, Andrew. And one thing that's really fascinating is, and Andrew hasn't even seen these numbers because I was just crunching them like over the weekend. My partner was away in Christchurch while I was in Auckland. I thought, what am I going to do? I'm going to crunch numbers.
Why didn't you come down and see me?
No, mate, I didn't want to come down. I wanted to stay in Auckland and I had to be on the radio, and then I wanted to crunch my numbers. And one company, HouseMe, right? HouseMe is a developer. I'll show you HouseMe's website, actually. Did it go? What happened to my thing?
Use the discount code Opus.
No,
Ed McKnight.
No. There's no discount code here, but I just want to show you what they do. They do like minor dwelling, like
a granny
tiny
flat.
homes, granny flats, those kinds of transportable homes. Just as an example, they have come out of nowhere since, when did they start? They started 2019, BCI started picking up their consents. They have rocketed forward to over 300 consents per year. So they did 309 in 2022. Over the last 12 months, 287.
Interesting that they've dipped back a little bit, which I presume is because people are saying, you know what, I'm just going to hold fire for 12 months, see what the government comes out with, save a bit of money on what I need to do.
Yeah, and I actually have talked to some people who own tiny homes or, these kinds of transportable home businesses, and some of them are saying actually it is pretty tough at the moment because people are saying, hey, look, want to add a minor dwelling, want to add a transportable home to my property, but I'm actually just going to wait for the rules to change because then I'm going to potentially be able to save a bit of money. I was about to say, and somebody's just said yes, but I realised it was Andrew Nicol down there in the comments section as well.
Also, I think that as a result of this, you are going to see more companies popping up offering this as a service as well.
Yeah, I think that's probably a fair call as well. Coming to November, what do we expect to happen? The rental market, I'm giving it a 52% likelihood. The rental market's starting to recover. What's really important to recognise is that if you go out and ask property investors, is it easy to find good tenants? And we look at the number who say yes, and we look at the number who say no, and we take the difference between them. At the moment, more landlords are saying, you know what, it's actually really tough to find good tenants at the moment. This is according to Tony Alexander's survey of property investors. So a net 22% of property investors are saying it's really hard at the moment. Now, just keep in mind when you're looking at this data that the rental market is cyclical, right? So if I took you back to, I think it was about 2022, we saw that again, we're in the same position. More property investors were saying it's hard to find good tenants compared to those who are saying, actually, it's pretty easy. And I remember at that time getting emails from people who are seeing this data being like, is this what it's going to be like forever? Effectively leading a little bit into, I don't want to be mean here, but a little bit of that extrapolation bias I talked about when it comes to Uncle Lester. It's really hard now, so is it going to be this way forever? Well, no, the rental market is cyclical, right? Just like we saw that at the start of this graph, it was pretty easy to get good tenants. Then it was difficult. Then it was really easy. And now it is a bit more difficult again. We do tend to see that change within the market. One thing that I want to show you that a lot of people won't have seen in the past is some data out of Trade Me. And I want to show you what like property managers actually look at. So if you were a property manager and you get access to Trade Me's back end, and watch this, Andrew, because this is really interesting. We've seen the number of searches, so people going on to Trade Me and searching for rental properties. It is up 2% in October, right? So 6.6 million searches on Trade Me. Look how only a couple of months ago, by the way, the searches were way down. So in May 2023, we saw almost 8 million searches on Trade Me, people looking for rental properties. Now, obviously, that is a high number of searches compared to the number of New Zealanders. It's because if you're looking for a rental property or you're looking for a house, you're doing lots and lots of searches because you're trying to find the right property. So this gives you a sense of the demand, right? Let's compare that to supply. Oh, where's my supply graph gone? There it is. So if we look at the number of listings, though, the number of new listings on Trade Me, we see we are up 26% year on year. So rental demand is pretty stable, but because we are seeing way more listings at the moment, that is the reason why it is tougher for property investors to find good tenants at the moment, because we've got the same number of tenants, but as a whole, there is more supply. Now, that isn't the trend across the whole country, but I just wanted to show you the numbers that property managers are looking at and seeing to get a sense of what is happening with demand and supply at the moment. Again, it's pretty tough now, but I expect that we'll probably see a bit of a change when it comes to November next year. Now, I want to do one final poll before we hand it over to Andrew to give us December's prediction. I want to know from you guys, do you plan on buying an investment property in 2025? So click the top one if you're like, yeah, I plan to buy an investment property. No, if it's not this year, not in 2025. And maybe if you're on the fence, like, I don't actually know whether it's the right time for me. I'm not sure if I can do it. Just click the bottom one. It'll be interesting to see, like, what's our mood at the moment here as property investors.
And I see Aaron's just put, I wish, which I completely get, Aaron. I know that there's a lot of investors out there at the moment who are just keeping their head above water because interest rates are punishing. Their property values have come down a little bit. I work with people all day, every day, looking at their portfolio and kind of figuring out what the next steps are. The great news is, for most people, you're going to feel the effects of lower interest rates next year. If your interest rates are coming off, you're definitely going to start to see the market move in the right direction. It's only going to be the start of it, but it's going to be a nice feeling to kind of, oh, I've got a bit of growth, and oh, the cost isn't quite so bad. There's nothing wrong with not being able to buy next year if that's not you. One thing I say to all investors that I work with currently is, keep educating yourself, keep watching the market, and keep working with your mortgage broker to make sure that when you do have the opportunity and when it's right for you, if it's right for you, that's when you strike.
And let's close off that poll, and producer Dave, share that across everybody's screen as well. Andrew, I can't actually see mine. What are you seeing on your ones?
45% of people said, absolutely, I want to buy next year. I think there were about 20%.
Oh, there it is. I've got it here.
30%. 45% said yes. 30% said not in 2025. And 25% of you said, I'm not sure yet. And that's cool.
So, Andrew, let's come to our final prediction of the night. What do we expect to happen in December of 2025?
December 2025. So we were talking about this today. I can't believe it. We will have released episode number 2303 of the Property Academy podcast. We'll be doing 6 years as of next year sometime. And probably early next year, we're going to hit 10 million downloads. Amazing.
Total.
I remember in our first few months, we had a total of 15,000 downloads. And we've been going for about 3 months, had 15,000, just ticked over 15,000. We thought we were amazing. Now we get there in a couple of days.
You still think you're amazing.
I am amazing now.
And so those are our 12 predictions for 2025. And I think the key takeaways for us is that interest rates have actually already fallen a lot. Sometimes people are saying to me, Ed, when do you think interest rates are going to come down? And my message to them at the moment is they've fallen by almost 2% in some cases, right? Like the 1 year rate is sitting at kind of 1.8% below the peak advertised rate. the other thing is that banks probably will lend you more money over the next 12 months compared to what they have over the last 12 months. And this is something that I feel quite passionate about. Number 3, there are reasons to invest if you want to find them. But also, number 4, there are reasons not to invest if you want to find them too. And it's quite funny that sometimes a lot of it comes down to a bit of mindset. If you want to think that it's a good time to buy, you can find data that supports that hypothesis. If you want to find reasons that it's not the right time, and I don't mean that in like a, oh, your Uncle Lester kind of way. I mean it more at a, like, hey, if you genuinely believe it's not the right time to buy it, I could find you data to support that hypothesis too. So we've kind of got to come to our own conclusion.
Yeah, and also it's got to be the right time for you. So if you think about a couple who maybe are going to start having trying to have a family next year, might not be the right time for you to buy. If you're going to drop to one income and you can't afford a top up, not the right time for you to invest. And this is why it's not a one size fits all. If you want to get a really good deal, there are absolutely the best deals that you might get in the market because of prices being low at the moment, but it is going to cost you. So that's about getting that balance right.
And I want you to stick around for questions because I see there are over 99 questions. And if you put them in, generally, sometimes we see the questions that were asked most recently. So we tend to answer those ones. So make sure you're popping the questions in there. But just before we get to them, even after releasing 1,888 podcasts, doing 50 webinars, even after people have signed up for Opus Plus and maybe even read our book, people still ask me when they see me on the street and say, hi, Ed, they'll still say, what does Opus actually do? And I just want to take 2 minutes to tell you so you know what your options are. The first thing we do is we help people create a property investment plan. So I kind of showed you some designs of my wealth plan before. That is the piece of software that we use to help you build that property investment portfolio that we're going to integrate AI into a little later on early next year. And you can see on the left, that is Andrew actually at a meeting with a property investor creating a financial plan. And then once we've created that financial plan, we help people find new build investment properties for them. And we just focus on new builds here at Opus Partners. That's an image of Kathy Faulkner, one of our financial advisors, in a real meeting with an investor looking at new build properties. And I really want to be upfront with you around if you decide to work with a property investment company like Opus, not that we're the only ones in the market, how do we actually get paid? So the way it works is that you'll go and talk to a property investment company, and a property investment company will have relationships with a lot of developers. We've got over 97 developers that we work with. And if we can find you the right new build investment property and you say, hey, look, that's a great investment, I'd like to invest in that, that's where we earn a fee from the developer. And that's how we're able to provide a service to you without actually charging. Now, it is really important to remember that you do not have to use Opus. We are not the only property investment company in New Zealand. And if you went to Google and started looking through, yes, you would see us probably at the top. That's cool. But we do have competitors. There are other people who do the thing that we do, whether it's Propeller or Positive Real Estate or Property Factory, some of those ones. And that leads to a really good question of, well, why would I use Opus Partners as opposed to somebody else? And one of the big differentiators is kind of what you've seen tonight. We use a lot of data to try and help you make the best property investment decision you possibly can. On top of that, we've got a lot of properties that you can't find on TradeMe. The developers we work with don't put them on there. We just keep them for Opus clients and Opus investors. On top of that, we try and find really good prices and deals. And I really like to prove that to property investors and show some comparable sales. So every property we show you should have a table like this that shows you, okay, this is the property we're recommending, but how does that compare to other properties on the market? I want to prove to you that it's a good deal. I don't want you to just take my word for it. And the last thing is we've kind of got all the support you need in one place. Yep, we can find you the property and give you some financial advice through Opus Partners and Opus Property, but we've also got a property management company. We can also help you get the mortgage. We can also help you with all of your accounting. So it's everything that you need in one place. Now, look, I'm not going to keep going on about it too much, but I just want to say, if you want to create a property investment plan and you think this sounds quite interesting, you want to take it further, then I want to offer you what we call a portfolio planning session. It's that first meeting that I kind of talked to you about before where Andrew was creating a financial plan for people. There's no charge for that because we get paid the way that I told you before. Now, if you want to sign up for that, I'm going to put a final poll across your screen. Just click the top one and you'll get a link to book tonight. And if you're currently a client or it's not the right time for you, just click the bottom one and you won't get a link. And I'll get producer Dave to put that across your screen right now, just so that you guys have the option about saying, hey, look, I want to work with you guys, or hey, yeah, I'll give you guys a meeting, or nah, look, it's not the right fit for me. Loved your webinar, but all good. So I'll put that across your screen now, just so you have the option to say, yeah, I'm going to put my hand up and have a bit of a meeting before Christmas. One last thing I'll just say as well is if you're like, oh, bugger this, can't be bothered clicking that thing, you can also scan this QR code that Andrew's head on top of my body.
Weird. Why do you do this?
I just haven't changed the photo
Why
yet.
not?
I'm not the graphic designer. I don't put the slides together anymore. You can also scan that QR code and you'll be able to book that session. Rightio, let us just mention, if you want to learn more, listen to the Property Academy podcast. It's every single day we release a new show to keep you up to speed with the property market. Episode 1888 went out today. Very lucky number. Episode 1889 goes out tomorrow. You can also subscribe to our YouTube channel. We release 2 new videos every single week to keep you up to speed with that. Or you can also buy our book. It's currently in bookstores, or you can go to wealthplanbook.com. We've got free shipping all around New Zealand. With that, we are going to open it up for questions and answers and kind of ask you guys, what else would you like to know?
It's a lot of questions tonight. Not the 99 you were reading before. I think that was the comment. So let me start from the top. When's the best time to sell a property? Someone's asked. Now, the best answer for that is never, or as long as possible. If you're in a situation where you have to sell a property, or you're coming to retirement, or you want to sell it and pay off your mortgage, or there's a reason to use that money, then now is not the time. Because right now it is a buyer's market. They're going to get a better deal than you're going to get selling the property. Now, depending on where you are, if you're in Auckland, for example, I'd say hold for at least 5 years if you can. If you're in Christchurch, I'd probably say a similar timeline. If you're in Wellington, I'd probably say it's as good as you're going to get in the next 5 years. You might sell it now, for example. That's my best guess. But if you're holding, but you bought for the long term and interest rates are hurting you right now, but you can get through it, my answer is just weather the storm, because you'll make a lot more money in the long term.
Old mate has asked, what wine are you guys drinking?
Lots of questions about the wine tonight.
It's because usually we've got cocktails, because there's a bar downstairs underneath where we record this. It's a Wild Irishman Pinot Noir by
from
Kinross.
Kinross are friends of the show. Great wine.
Yeah. But Wild Irishman is the winery. Highly, highly recommend. I saw another person say...
Here's one for you.
Oh, yeah?
Why, and I know you've done an article on this, why did Chris Luxon sell 2 of his properties at what is supposed to be the bottom of the market? Does he know something that we don't?
Yeah, that's a really interesting one, because I had a number of journalists calling me up about that. And I said, do you know what? It's actually really strange that the Prime Minister is selling some of his properties, given that it is an absolute buyer's market. So why is he selling? And what I said to the journalists down at, I think it was the Post, I was like, well, I think the main reason is he's probably got another use for the money. He's certainly not struggling with high interest rates, because it's been widely publicised that most of his properties are mortgage free. So the cash flow on them should be pretty good. And the only thing I can kind of guess is that, hey, look, he might have a better use for that money. Maybe he's investing in something else.
And maybe it's just not a good look. I mean, there is a lot of... Ed mentioned that property is a bit of a political football just before. And I do think, as politicians, maybe it just kind of, it maybe doesn't make him feel like he's doing the right thing. So he's decided to get rid of it.
I want to answer another one. Okay. Somebody said, do I have to be an Opus investor to use your app, Opus Plus? No, you don't. It is completely free. It will be free forever. You can literally just go to opuspartners.co.nz. And if you go to any page on the website, you can see up here, Opus Plus. If you click on that, it will take you through and you can sign up for free. It's taking me through to an example dashboard that I've got up. You can use that completely for free. And the vast bulk of the features, if I can make them available for you, they will be available. Some things like getting your property management stuff, you've kind of got to plug into the right software. So that is just going to be if you're using Opus Property Management. But you don't have to buy a new build through Opus Partners in order to use Opus Property Management. So maybe you might like to switch to them as well. But that's your choice.
And there's some lots of great feedback. And again, this is something that I use daily with investors. And bear in mind, I've been used to using Ed's spreadsheets for the last kind of 4 or 5 years. And now we're going to this online platform. This is just the start. This is the tip of the the iceberg. Ed and I are committing about $500,000 a year to making this app the best app that New Zealand property investors have ever seen. Sound like Donald Trump now. There are lots of questions about Donald Trump. So I'll come back to that. So do go and use it. Trial it out. It is absolutely free and it's going to be free forever. Someone did ask the question, I can't find it at the moment, and this is probably a tech question for you. How does Opus store the data? How's it protected? What's it used for? So if you put your information in there and you're not an Opus client, are we going to go and have a snoop around your portfolio?
So a couple of things. I just mentioned that we've actually got our privacy policy down here as well as our disclosure document. So you can jump in and see exactly how we manage and respect your data. But the main thing that we use it for is just to give you the cash flow and give you the numbers that you specifically want. At the moment, there isn't any marketing going on. We're not going and harvesting your data or like selling it off to anybody. Our plan is maybe if you've got a property in Auckland and you put it in there, maybe at some point in the future we might say, hey, look, we've got this new thing where you can see all of your property management statements through Opus Plus. Do you want to switch over? But that's basically the extent of it. There's no kind of nefarious purpose going on where I'm selling it off to somebody who's doing something wrong with it. One thing I will say as well, I've been getting a lot of questions around cybersecurity. Like literally at the moment, we have got a third-party Australian cybersecurity agency going through the website, going through the app and making sure that it is absolutely secure. We've already been running cybersecurity checks on it previously, but to give us that additional layer of assurance, we do have a company called CyberCX going through. Once we have that report, and we have fixed anything that's come up, we will release the actual report so you can see like, hey, yeah, they have had a third-party cybersecurity agency come through and this is what the agency said. They said apart from, this is hopefully what I want to get to, apart from a couple of small, like insignificant things, like it's all good. So that's where we want to get to.
Rachel's asked the question, and again, this is a common theme of tonight. How's the US and Donald Trump being elected going to influence New Zealand's interest rate, she's asked, but also property prices, things like that. So we actually did a post-election podcast, mostly because Ed wanted to rub in my face that he won our bet on whether or not Donald Trump would get in. I said no, he said yes. He was right. Even a broken clock is right twice a day. Anyway, to answer your question, Rachel, we think there is going to be a little bit of impact. There might be some inflationary impact, but I don't think it's going to be major. If you want to listen to that entire podcast, the great thing you can do with our website is go on and just search for anything we've spoken about. And this was in my private property last week, so edition number 134. You can search for that. If you're not subscribed to private property, this is a Thursday newsletter that comes out, and we talk about something that's happened during the week, or in this case, it was the day after the election results. But we might be talking about, changes to tenancy laws. It's really useful information. There's always 2 articles, 2 videos that we want to promote as well.
So let me jump in as well. So one thing that's quite interesting here is I've got red for Republican, blue for Democrats. And what we can see is that whether the Republicans were in power, so this was like Nixon, followed by Gerald Ford, followed by Jimmy Carter, followed by Reagan, and then H.W. Bush. Sorry, I'm just showing off now. We've seen that house prices have continually increased under presidents of all parties. When I say all parties, I mean the 2 that are actually in there. Even under the Biden administration, we saw property prices rise slightly, even though we had quite a major crash within New Zealand. So one thing is we've kind of got to zoom out and say the US political system or US politics, no matter who's really in the White House, we tend to see that the New Zealand property market has continued to tick over, at least for the 55 years that I've got data for, which is about as long as I think anybody will end up investing. But I'd recommend that you have a look at this, because one thing that's really interesting is I kind of show that if you had $100,000 in 1970, and you decided to invest only when the Democrats were in the Oval Office, you would have made $344,000. Now, if you decide I'm only going to invest when the Republicans are in power, you would come out with $2.7 million. But if you said, I'm just going to invest no matter who's at the Oval Office, I'm going to put my 100K into New Zealand property, which was a lot of money back in 1970, you would have $9.2 million worth of property today. Now, the wrong way to look at this data would be to say, well, clearly the Republicans are better, so I'm going to invest when the Republicans are in the Oval Office. No. The reason behind that is if we look at it is for the first kind of 20 years in this data, it was primarily Republican dominated. So it's just the time period we're looking at. If I zoomed out and was able to get data before 1970, like I could choose a different time period, these specific numbers would be different. The point is we invest no matter who is in the Oval Office because we're investing for our future.
Someone's asked, what do you think is going to happen at the next OCR announcement? So I've got my answer. What's yours?
0.5%.
Yeah, I think 0.5 as well. I think there are economists that believe that you might see a 0.75% cut. I don't think that's realistic before Christmas because they want to control spending. And so again, you might want to pass on some interest rate cuts, but not send the signal that we should all go out spending over Christmas. And then what does that do for interest rates was another question. I think the answer is it probably won't move the dial that much. If you're holding out, fixing your rate, I'd probably hold out for another few weeks because we're not far off that. But if you expect to see a 0.5% drop in your interest rates as a result of the OCR going down 0.5%, you're dreaming, in our opinion.
Yeah, Duncan's got a really interesting question. He says, most of your discussions revolve around the Auckland market. How much investing do you look at in other cities in New Zealand, for example, the South Island? That's really interesting, Duncan, because we're currently in Christchurch at the moment, and I think probably half my portfolio's in Christchurch, and vast bulk of yours is in Christchurch as well.
Yeah.
So maybe we've talked specifically about Auckland tonight. That might just be because of around a third of the population live there, and it makes up kind of 40% of the economy. But look, I would be quite happy to invest right around the country. Wellington's looking a bit shaky at the moment, but I think there'll probably be opportunities over the next kind of 3 to 5 years. Christchurch, I'm still pretty bullish on. Rolleston, Queenstown's one of the only places in New Zealand at the moment where we are seeing property prices really rock on and rise. So certainly would be looking around the country as well.
And the funny thing, Duncan, is Opus started 11 years ago, and we've been accused previously of talking too much about Christchurch, for example. Why don't you talk about Auckland more? Why don't you talk about Wellington more? We talk about wherever the data is saying is a good place to invest, and so we will be very bullish about areas in a particular cycle. Right now, Auckland is probably the number one place if you're looking for high capital growth, in my opinion, with a robust economy. But again, we only care about what the data says. And if you came to us and said, hey, I really want really high income, I'm not interested in capital growth, that doesn't matter to me, it might be Wellington, which is not what I would talk about for a lot of people.
What's interesting as well is I'm seeing a lot of comments. Rach has said Tauranga, Commercial Cornerstone said Hamilton. I've seen other people say Helensville. What do you think about this? What do you think about that? Best thing to do is jump onto our website and look for the Area Analyzer tool. If you Google Opus Partners Area Analyzer, this is going to be the first thing that comes up because you can put in any area in the country and it will give you free data about how it's going. So somebody asked about Tauranga City, so let's jump in and see what the numbers are saying at the moment. It sometimes, by the way, is a little slow when I'm sharing my screen on a webinar. So for Tauranga, we're giving it an Opus area score of yellow. So we think it's kind of somewhere in the middle. Probably not the best place to invest, probably not the worst place to invest. One of the things we don't like about Tauranga at the moment is that its house prices are really high. Which means it can be quite difficult. In June this year, CoreLogic said average house price in Tauranga about $1 million. Property cycle, it's looking a little bit okay. Let's see how undervalued or overvalued it's looking. And we can see, here we go. So if I look at Tauranga's house prices, they're looking about 2.4% overvalued at the moment. Now, a lot of New Zealand is actually looking overvalued, so that's why Tauranga's kind of actually not in the worst of the worst. There are some places that are way overvalued. But this is just how you can go and get some data about the Tauranga rental market, see what we think about it, and you can put pretty much any area, any suburb. There are over 1,000 suburbs in there. There are 67 council areas. There are 16 regions, and you can get the area. You can get whatever data you specifically like. We're trying to collate everything you could find on the internet and put it all in one place. And I see Dana Lee said, your area analyzer's been amazing. Look, I'm a first home buyer with an investor hat on, only wanting to buy for financial security. So it's really good to hear that. Dana, it sounds like you might not even be using us, which is awesome, which is fine. But I'm glad that we can still help you using some of our tools.
Someone asked, how do I give feedback on Opus Plus? So can you just, while you're sharing your screen, just talk about that while you're bringing.
Yeah, I can do that right now.
Okay.
So if you jump into Opus Plus, there is this feedback tab up here. Now, if you click on that, you can either send us an idea or report an issue. And what's been really good, by the way, I know that if you're on Android, I don't know what it is, but there's something annoying with that feedback tab that's covering some stuff. I've got my developers onto that at the moment. But we have got over 200 pieces of feedback from people like you who are using Opus Plus and are giving us feedback on the tool. I'm getting my developers onto anything that's like really, why am I still sharing my screen? I was like, how do I get out of this? Feedback, that's right. We've had over 200 pieces of feedback and I'm reading that all of the time. I've got a team of 2 people who are helping me kind of get through it and say, okay, what's a priority? When can we do all of this different stuff? And some of the things you've seen, like that table that actually shows you the numbers, that was an idea that one of you guys recommended. What's really funny about Opus Plus as well, Andrew, is I did it because some people said, Ed, I like your spreadsheet, but there's too much detail. So I said, oh, good, I'll build an app for that and I'll take all the detail away. And then some people said, but where's all the detail? So we've given it back to you and tried to make it simple again. What else is piquing your interest, Andrew, or do you want me to pick a question?
Sorry, I'm replying to something individually.
I'll come up with a question. One thing that somebody has said is, have you ever looked at the numbers of overseas property investments? Oh, we actually have looked at a couple. We went over to Australia recently, just a couple of months ago, to kind of look at what's happening over there. One thing to be really aware of once you start looking overseas is just the amount of taxes that are over there. It absolutely astounds me how much stamp duty you have to pay if, as an overseas investor, you want to buy a property in Melbourne, for example. I think we had somebody on the podcast, it was well into the teens. I can't remember if it was 12% or 17%, but whatever it was extraordinarily high. So that's one of the reasons why we focus here at Opus Partners on New Zealand, but certainly we'll look at some of them. One anonymous attendee has also said, hey, on Area Analyzer, for some of them, there's coming soon for some of the suburbs I'm looking at. One of the reasons for that is if you're looking at an area like, let's call it West Coast, which is a smaller region, sometimes there's not enough data. So in some suburbs, there might only be a couple of property sales per year, in which case we can't give you really good data. And so I don't want to give you really bad data that you can't make decisions on. So that might be why there's coming soon. We're working on some of that stuff. But for a lot of the suburbs, for some of the stats for some of the data, we've got like up to 90% coverage of 1,000 suburbs in the country. So pretty happy with that.
Okay, I'll answer 2, give you a break for a minute, catch your breath. So someone said, how long do you think the buyer's market will last? So my predictions are that we're going to see a relatively busy November, a relatively busy December, and that's probably going to be a result of property prices are going to move a little bit. Then January goes flat. We all go on holiday, let's face it. By February, you'll see a bit of momentum. What happens every year is investors leave the market and then they come back and they've got their New Year's resolution and they didn't do something last year and they're so angry that they didn't do it. They're going to do it this year. So they sign up for the gym and then they go and look at investing in property. That'll carry through to March, probably a little bit of April. Then winter kicks in. And when it comes to winter, us Kiwis hate it. So we don't move house, we don't buy properties, we don't do anything. School holidays and Easter, all of that kick in. It'll be really, really quiet next year in winter. It won't be as quiet as this year, but it'll be quieter than what we've experienced at the end of this year. Then when we get into spring next year, there's going to be some real momentum. So if you're wanting to buy in Auckland, start thinking about it in winter at the very latest, because I think the deals will have dried up. A lot of that stock that's been sitting on the market, developers that have built stuff and they've rented it out or they've kept it on the market for a while, they will have done their deals by then. And when we get to summer next year, I think it's going to be running really hot in areas that are undervalued. So I'm talking about Christchurch, talking about Auckland, maybe Queenstown. Queenstown's such an anomaly. Someone asked about it before. I called it the other day a one-trick pony on our podcast. I've said that for years. Keeps performing that trick. Now, will it go up forever? Absolutely not. It will have some flat times. It might have some drop as well, but it is still performing really well as tourism creeps back in. So I do think there's some opportunity there. Our last month's webinar, we rated different areas, our top 3 and our bottom 3. So go and watch that if you want to get some ideas around that. And then the other one, I was
just going to support your point around what's going to happen. If you Google like Ed McKnight One Roof, you'll be able to see all the articles that I've written for the New Zealand Herald. One thing that I was just laughing about as I was scrolling through is it says, revealed the renovations that could add 400K, revealed the expensive regions, revealed. I didn't realise that I revealed so many things, Andrew. But one thing I'll say is, by the way, I don't write the headlines. Sometimes people give me shtick for some of the headlines. I'm like, I don't write those, but somebody else does. But one thing that I'll just mention is specifically what Andrew was saying. So he said, hey, look, the property market goes quiet in January and December because we all go away. The data actually supports that. So on average, in January, house prices go up by 0%. They stay absolutely flat. In December, on average, they only go up 0.1%. But what happens in February, we start to see that house prices on average go up by about 1.3%, which is really fascinating as well.
I'm going to read one here, which caught my eye. For my third investment, I went on my own with Titus Group, which you, Opus Group, had blacklisted. I should have listened. They've been a bit average, and I'm having trouble with wastewater pump blocking. I've heard from other investors and other Titus developments that have had a similar issue. We're at a stalemate about who's going to pay for the water pump. Titus say it passed council checks and it's not their responsibility. We have contractors that say that it's too small a development. Any advice? Yeah, I definitely have advice. Look, we do make public people that we recommend and we don't recommend. There are some people on that list that from experience, we are saying we won't recommend. We've used Titus Group to provide properties for investors in the past, and as a result of our experience, we've now blacklisted them. You're right. I think for your particular situation, it's probably a relatively affordable fix, which is a good thing. So you can go to the disputes tribunal. It is very, very easy. I think the cap is $30,000. So I would go and file with the disputes tribunal. You don't need a lawyer to do that. And I know that there are a lot of developers being held to task for up to $30,000 for things like this. So you should absolutely do that. If you have any trouble, email me directly. I'll put you in touch with someone.
And if you want to see that list that we're talking about, we've got it publicly available. The developers Opus recommends and the ones we don't. And, oh, by the way, read the compulsory part. How not to use this list. This is very important to read that. But if you type in somebody like Titus, they're on our don't recommend list. In fact, we've got our full don't recommend list down the bottom. Now, I want to just answer as well. We had I saw somebody mention on YouTube when I released. I was talking about this list on YouTube, and somebody said, "But Ed, doesn't that make you guys biased? Because you guys earn money when you help people buy an investment property through a developer. So what if you just put the people who don't want to pay your fee on the do not recommend list so people buy through you?" And I think that's probably a fair question. It's actually one I'd never considered before. But there are a couple of protections I just want to mention that are put in place. Pretty much for any of these, we've got reasons why. So you can either ask us. I mean, we've got some reviews on like Duval and Fletcher Residential to explain some of the reasons why we might not recommend those properties. For people like Reed Myers, we've got podcasts about some of the reasons why. We were warning about them for years. One other thing that we do to protect against that is every developer pays the same fee. So if you're an Auckland developer, you pay us the same fee whether your property is $500,000 or whether it's $1 million or whether it's $1.5 million. Same in Christchurch. You pay the same fee no matter what the price of the property is. And we try and keep things pretty level so that we're not incentivized to make those kind of judgment calls, because we just want to put out really good information and justify it to you so you've got the confidence in it.
And I've seen quite a few comments in the chat tonight from people who have worked with us saying, hey, we really appreciate your transparency. One of the things that we did about 5 years ago is we started doing these webinars and we started doing podcasts and we started telling you everything. And if you want to use our services, awesome. We want to help you. If you don't, I still want you to be a successful property investor. So I don't care. I want to give you the information so that you can make informed decisions, because we don't want to see someone lose money from paying a dodgy developer and then not getting the product, because that's bad for the entire industry. Someone asked the question, is it worth having a property manager while I only have one investment property? Now, if you've just got one rental, you might be able to manage it yourself, but I guarantee you don't necessarily have the time or the skills to be able to do it correctly. So I would say no matter how many rental properties you've got, treat it like a business. If you can't afford the property manager, you probably shouldn't buy the investment property in the first place. And it also limits you to where you can invest, because you're probably going to have to live locally. Someone else said, I'm a DIYer. Does that mean I'm limited to where I live? Yeah, it probably does, and that's probably not a good thing.
We'll probably do just 3 more before we wrap this up. I'll take one. Bobby's said, look, there's been a lot of media recently about capital gains tax. What's your thought about the likelihood? So Andrew and I disagree about this. I think on one podcast, Andrew said, I think it's an inevitability that it is going to come in. I say, I don't think that's the case at all. I don't think that it has to come in at some point. But I could certainly talk about the next 5 years. I think there is almost no chance of it happening over the next 5 years. I'll tell you the reason why. Certainly for the next 2 years, there is no way that a national-led coalition government would ever introduce a capital gains tax. One of the main reasons behind that is if we look at who are some of the supporters of that coalition government, or who are some of the members of the coalition government, we've got the ACT Party, which would definitely oppose that. National as well. They oppose a capital gains tax as well. You've got to look at what National have actually done. They've taken the Bright Line test, which was effectively New Zealand's version of a light capital gains tax. They've taken it from 10 years down to 2 years. So certainly over the next 2 years, where we've got a national-led coalition, it's pretty likely that we wouldn't see that. Then you've got to think about what happens at the next election. Look, I'm not in the business of making political predictions, but here's one. Typically, we here in New Zealand elect governments for at least 2 terms. So previous Labor government, 2 terms. Government before that, National government, 3 terms. Government before that, we had the Labor government. That was 3 terms. Government before that, it was Jim Bolger's national government, 9 years. Government before that, we had David Longage's government, 6 years. So typically we do tend to see, at least 6 years worth of government. So I'd be pretty confident that over the next 5 years, we are unlikely to have a capital gains tax. But what we do know is that Labor is likely to propose some form of either capital gains tax or wealth tax at the next election. So you'd never say absolutely not. You'd say, we'll see what happens at the next election. What else is interesting you, Andrew? We've probably got time for 2 more.
This is one that we actually covered on the podcast today. Are the value of townhouses going to drop? There seems to be a massive oversupply.
Oh, you're asking me that one?
Yeah,
go
go for that. You might as well go for that because you have our sheets there and our data.
Yeah, I got data about that. So one of the things, I love question times because I'm like, go to Google.
And actually, someone asked before, Aaron's already answered it, where do you find the link of the developers? If you Google anything with Opus Partners after it, you're probably going to find it.
Yeah, so there was a really good one. If you Google Opus Partners Townhouse Oversupply, you'll get my article that I wrote it was about last year. Gosh, I should update that. Holly Jean 18, if you're on the webinar tonight.
Cheers.
Can you pop that on our list and we'll get that updated? I think that'd be a good one to update. Are there too many townhouses being built in New Zealand? And one of the really interesting things that I talk about is, you know what? The percentage of townhouses, or the number of townhouses we're building in New Zealand, has increased massively. It's gone from under 7% of new builds being consented all the way up to over 40% of the properties being consented. It is absolutely enormous. And so the question you've got to ask yourself is there an oversupply? And the way I kind of answer this in this article is I say, well, if there was an oversupply, what symptoms would you expect to see? So let's diagnose this. What symptoms would I expect to see? Well, I would expect townhouses to take longer to sell. Well, do we see that? No, we didn't see that. We saw that it was actually pretty similar all up. Okay, well, townhouses, maybe they're going to fall in value more than houses if there's an oversupply. Did we see that? Well, no, we didn't. We actually saw that townhouses were falling at a slower rate than houses. Okay, what else might I expect to see? Well, are townhouses increasing in value more slowly than other property types, and is the margin increasing over time? No, it's actually pretty similar, and we're seeing that over that kind of rolling 12 months. They're almost moving in lockstep. There are some differences. Sometimes houses are increasing faster than townhouses. Sometimes townhouses are increasing faster than houses. But overall, at that time, I wasn't seeing a lot of evidence, a lot of symptoms of that oversupply. We'll get that updated because I haven't looked at that recently.
Someone asked the question, can I have a wealth plan through you if I've already got a mortgage advisor? The answer is yes. So the wealth plan is done by a financial advisor in investments in our company. So that's about investing in property. So you can come in and see one of the property partners. They'll map out what your wealth plan looks like and then upload that to your Opus Plus profile. We've got subsidiary services, so you can use the mortgages, the insurance team, the accounting team, property management team, and all of that feeds into Opus Plus. But what you choose to use and don't use, that's completely up to you, and you can turn that on or off in the future at your will. Someone else said, what's the advice? I know you said last one, but last one now. What's the advice for a first-time investor for 2025? I think over the Christmas break, I'd educate yourself as much as possible, and I would engage a mortgage broker. Maybe talk to Opus Mortgages, or if you've already got a relationship, talk to them and find out how much you can borrow and what levers you can pull to increase your borrowing ability if you want to go to a higher purchase price.
Fantastic. Hey, we're going to wrap it up there. Thank you so much for being with us here tonight. It's amazing that there are still hundreds of you, well over 400 of you, still sitting here asking us questions about property investment here in New Zealand. I think it's great that it's like 8:30, you're still here.
On cut
90
day.
minutes here. I think it's so wonderful. So we're going to see you guys later. We'll see you around. Thanks so much for being with us.